Hi there, I'm Champion Trader Kevin Davey, and today I'm going to talk to you about 3 different position sizing approaches, and we're going to compare them to a baseline. So let's get started. So in this video, I'm going to look at 3 different position sizing approaches that you can do, and I'm going to compare it to a single contract, and we're going to look at a couple different examples. So first we have the Martingale strategy. Pretty simple. You start out by betting 1 unit. If you lose, you double the next bet. When you finally win, you go back to 1 unit. Okay? Then there's a modified Martingale strategy where instead of doubling, you multiply the last bet by this factor Z. And when you finally win, you go back to 1 unit. So in this particular example down at the bottom, Z is 1.5. So it's not as rapid an increase in contract size as a Martingale. Then the third strategy is an anti-Martingale, where instead of betting 1 unit and losing and doubling, this one's going to be if you win, you double the next bet. And then when you finally lose, you go back to 1 unit. And as you can imagine, there's also an anti-modified Martingale where instead of a 2, you use some other factor that's between 1 and 2. So those are the ones I'm going to look at, and I'm going to look at relative to a baseline of just trading 1 contract. My first example is July of 2024, the Australian dollar, Japanese yen. Most people were doing this yen carry trade where they were doing small, long trades for the past few years. Nice uptrend until the market collapsed, and a lot of people got blown out with the Martingale approach. So if you compare all these, the red is the worst, green is the best. You can see the anti-Martingale was the best for profit, the best for max drawdown. The least amount of max drawdown was just your baseline 1 contract all the time. And then if you look at profit and loss divided by the max drawdown, the anti-Martingale came out to be the best. So for this example, all the ones I looked at, anti-Martingale, that was the winner. And Martingale was not that good at all. Example number 2. This is a portfolio of 5 different strategies. So all these strategies were built using my strategy factory criteria. These are strategies I actually give out in my course to students, so students have all the code for this. And I looked from 2020 to the present and looked at the real-time hypothetical results. So I developed these strategies before 2020. So this is all like real-time results. It's not an optimized backtest or anything like that. And what you can see when you just look at profit and loss, I have the individual strategies here. You can see the baseline is the worst for overall profit. Now remember, it looked better in our first example. And the best one for profits in anti-Martingale, although the 2 Martingale cases are pretty close. The one other interesting thing to see here is there's a crude oil strategy that with the Martingale actually lost money. So this was a winning strategy, and I actually made it a loser by my choice of position sizing. So that's an important thing to kind of keep in mind, is that you can really screw things up if you apply a bad position sizing approach to your strategy. So that's the profit. Here's max drawdown and the profit and loss divided by the max drawdown. Well, now you see the anti-Martingale, even though it's the best with total profit and loss, it's the worst as far as drawdown. It had the highest drawdowns. And the best overall for this ratio of profit and loss to max drawdown was actually the baseline case. Go figure. And then I also looked at average drawdown, and the same sort of thing holds. In this case, overall, the Martingale, which is a modified one, because they had a factor of 1.5, was the best. Way over the column on the right, that's the green one. And the worst cases were the anti-martingale. So when you look at it all together, you get this mixed bag, because with the Australian dollar, Japanese yen, the anti was the best in a couple cases, or the baseline. But for the portfolio, anti is usually the worst, and the baseline is usually the best. So depending on the strategy, you can get something different as far as what's best. So again, anti-martingale was better with the Forex example, but martingale was better with the portfolio example. And somewhere in between on both, the baseline, that looked pretty good for both of them. So what does this mean? Well, you can see from just the profit levels of comparing it to the baseline, I didn't point them out, but you could see them in that table. The martingale and the anti-martingale can give you what I call skyrocket profits, huge profits. They can give those to you. They can also wipe you out. Look at that crude oil strategy I showed you with the martingale, where it turned a winning strategy into a losing strategy. So you got to watch out. The general conclusion here is there's no universal best approach. So I can't say, oh, hey, always do this or always don't do this. Can't really say, because it depends on the strategies involved. And it also assumes, or it also depends on the data I use. So don't assume that just because it worked in the past, it's going to work going forward, because that's not necessarily the case. And, maybe I should take a look at this a year from now and see what happens. If you think so, leave a comment. Say, hey, come back in a year, redo this video, redo this analysis, and see what you get. Well, I hope you found this informative. Looking at martingale, anti-martingale, modified martingale, modified anti-martingale, and baseline, there's no consensus on what's best, at least with the two examples I did. That's something to keep in mind as you build your own position sizing. I hope you found this useful. Leave a comment, like I said. Hit the like button, hit subscribe. I'm Champion Trader Kevin Davey. Have a great day.